Welcome to the deep dive video update. And I use deep dive in a bit of a different context because every week I do a number of different videos. At the end of the weekend, I look through all of the charts that I used in the various videos and I pick out those charts that I didn't really talk about in any of the videos. And we have to look deeper into those charts to see if we're getting any clues as to what's happening. There are also some additional charts that are specific just to this particular video. This is being prepared for Monday, December 30th. Before I get into the actual video itself, I want to tell you about the SPX investing program. It's free for a few more days. It's free until the end of 2024. There's a link that'll take you to the website. There's a link that will take you to a video. If you have any questions, you can send me an email. Check that out. See if it's of interest to you. I will be locking it down in 2025. Also, this is just one of the weekly videos that I prepare. All of the videos on the outside are meant to tie into the daily video. Okay, so the first chart that I really just use in this video gives us an idea of the overall range of the VIX. The VIX is a fear gauge, and when the VIX is going up, stocks are going down. When the VIX is going down, stocks are going up. And we put a 50 period moving average on here and then turn the VIX invisible. And this gives us an idea of the overall range that we're seeing. And we're in a lower range right now, although we are starting to turn up as the market's been under some pressure. The VIX got very high right around the election, then it dropped down, then the VIX was going back up as the market was going down. So we're gyrating just a little bit, but overall we're in that lower range under 20, and that's usually a more positive environment for stocks. Another study that we look at with the VIX is a correlation between the VIX and the S&P 500. When we get above this dashed line, that means the market's getting quite nervous. And sometimes we pick up a signal in this chart and we don't see it in other VIX studies that we do. Well, we're getting a real low reading here. So there's been no need to show this chart. Also, looking at a ratio between the VIX, and then there's another kind of indicator of the VIX called the VIX of the VIX. It measures the volatility of the VIX. And as a general rule, when this is going down, that's more positive. When it's going up, that's more negative. But there are exceptions to that. And we've been starting to go back up as we're seeing the VIX actually outperforming the VVIX or the volatility of the VIX. It's usually more positive if this is going down. We also want to look at the speed of the VIX, and I use an RSI based on 9 periods, a momentum oscillator. And when we were going down, the VIX really shot up, and we were looking extreme there as stocks were going down. Since that time, we've worked down to more of a neutral area, and I usually only show this chart when we're getting an extreme positive or negative reading. We're not getting one of those right now. We look at the volatility of stocks as measured by the VIX, and the volatility of bonds as measured by the MOVE index, and then do a ratio between the two. And generally, when this is going down, that's more positive for stocks. But there's other times when this is going up, and that's also positive for stocks. We really spiked up because we're seeing an environment now where stocks are a bit under pressure because interest rates are going up. That means bonds are going down. And when bonds are going down, their volatility picks up. It would be a little more positive in this environment if this could actually start to roll over and go down. That means the volatility is underperforming in stocks versus bonds. Then, just for informational purposes, some previous new highs. The last all-time high was set in January of 2022. And since that time, as of Friday's close, we're up 23.91%. Then we set the kind of major low after we declined in 2022. That was in October of 2022. And we bounced up out of that, and we're up 79.86% from that time. Then a little over a year ago, we hit another low in October, and we're up 45.5% since that time. Just to kind of step back and say how well has the market done since these significant lows or previous highs. Then stockcharts.com has this thing called technical alerts, and I usually go through the daily ones in every daily video. These are all of the alerts that were generated throughout the week. We start from the bottom and work our way up. When we're more positive, we see a lot of green or blue. When we're negative, we see a lot of red. And Friday was a pretty down day, and that's why you see an awful lot of red. Other days throughout the week ended up being more positive, like Christmas Eve, even though we had an early close that day. But this can kind of give us an idea just by looking at the color differentiation here, if it's a negative day or a more positive day. And stockcharts.com also has what's called technical scores. And you can do this with a stock, a sector, a mutual fund. I do them on an index. And I have five indexes that we look at: the S&P, the Dow, the QQQs, which is the NASDAQ 100, the mid caps and the small caps, and then rank them on a score of 0 to 100. And coming in first place this week is the ETF for the NASDAQ 100, the QQQs. Now, it's stronger when we get a score up into the 90s, but still 89 is respectable. And even though we haven't really taken off, we haven't really been in that Santa Claus rally. It looked like it was going to happen, and then we were having a nice week. And then Friday ended up being a down day. We were up on the week, but we were down on that day. And that is not showing a lot of technical strength right now. So we're dropping down a little bit to 89.8 with the QQQs, but they're coming in first place this week. In second place is the S&P 500, also well off of its all-time high, but not all that far from it either, coming in with a score of 84.8. In third place is the Dow, which set an all-time high a few weeks back, since been pulling back, coming in at 75.3. And then we have the small caps, which this is the time of year when everybody's hoping that the small caps really go up. Well, as interest rates are going up, that's been really pressuring the small caps because small caps like lower interest rates since they have to borrow a lot. And if they have to borrow at higher interest rates, that cuts into their profits. They're coming in at 61.2. And then in last place are the mid caps, also kind of in the same situation as the small caps. They're growing companies. And it's now one of the weaker indexes at 52.2, where earlier in 2024, this was one of the stronger indexes. Then I have a short-term rainbow, and periodically I show this in the daily video. I usually only show this chart in this video, more for information. Even though it's based on the short term, I go back a number of years to try to get a bigger picture look. And what this does is it has a series of moving averages from 10 periods up to 50 periods, and I changed the color so it looks kind of cool. And we can just look and see now that we're still in an uptrend. Now, we had been going down and we dropped below the rainbow, but fairly quickly we were able to come back up out of the rainbow, so the lines are still going up. Now, if we can continue to go up, the lines will continue to go up and be smooth and just show that there's a solid upward short-term trend. If we come back down into the rainbow, the lines are going to eventually start to jiggle up and look more like spaghetti and could show that the short-term trend is vulnerable. We're actually negative right now in the short term since we closed below the 20-period moving average, and we're right about in the middle of this rainbow. Intermediate term, another rainbow going from 50 periods up to 100. And this is encouraging for right now in the intermediate term. We're still positive because we're above the 50-period moving average. We did come down and now we're back up out of the rainbow. If we can continue to go up, these lines will keep going up, and that will suggest that the intermediate term trend remains comfortably positive. Then we look at Bollinger Bands, and there's a number of different ways that you can use Bollinger Bands. I use them in one way on this chart. It's called the percent B indicator, and that's when we close above or below the upper or lower Bollinger Band, meaning that we've gone up or down too far too fast, because that tends to not happen very often. And when it does happen, it tends to not last very long, and we tend to move in the opposite direction. We're not really getting any signal from this. We're a little bit negative because we're below the midpoint, and you can see that up here on the top and then down here on the bottom. So since I only use this when it gets extreme readings, there hasn't been any real need to show this. We're keeping an eye on the 100-period moving average. Now, we're still far away from that. If we see more weakness, this chart will be in the daily videos. Right now, I'm focusing a lot on the 20-period moving averages and the 50s because we're below the 20s and above the 50s. We're still above the 100s here, and we're still going up. So this is more intermediate to a little bit long term with this chart, and it's still showing that things are positive. Now we look at the CMB Composite Index. This is a standalone trading system where you get in and get out when these green and red lines cross each other, and then the direction of the black line itself. I use this like an oscillator. When we're getting an extreme positive or negative reading, we're not getting one now, so there's been no need to show this chart. The mass index, we only get signals that are generated when this line comes up to the red dash line and the blue line. Not seeing that now, so I haven't been showing that chart. And it's kind of interesting. Back in November, we saw what's called a Pring bottom fisher generate a buy signal, which is kind of strange. The idea behind this is that when we're really screaming down, with a lot of fierce volume behind the selling, and then we're going down too far too fast, this can be a pretty good indicator to determine, okay, now we've finished bottoming and we're going to start to go up. Well, there's been a couple of times over the last year, back in April, when we were going down, and then we saw this crossover. That's a buy signal. And then the S&P did pretty well after that. Well, we saw a pretty good signal back in November, right after the election. We spiked up and then started to come back. This generated another signal that ended up being pretty good after that for the S&P. Right now we're going down though. So there's no need to show this chart until we see the black line cross back above the red line. We want to keep an eye on how far away are we from the 200 period moving average, and there's some additional studies that I use for that. And this just measures the distance that we see here. And we really pay attention to this if we get too far away. Well, we're not all that far away. We're 7.7% above the 200-day moving average. This is another measurement technique going back to the low that was set in October of 2023 and just how we've been doing since then. And then I adjust this at the end of each week to say, okay, how far are we from that low? We're up over 31% according to this measure. And then I keep an eye on declines. Like last summer when we were really going up, setting an all-time high, and then we started to fall down. This was the end of the day world that lasted a day or two, and then we bounced up out of that. But when we get down to about that 10% decline, because 10% is the definition of a correction, if we're 10% or more, and it changes the whole dynamic of the market. We started getting close to that 10% level, and then the smart money started coming in and buying, and that pushed us up out of there. Just because we're not at the high here, I've been just kind of keeping track of this. We were down about 4.48% when we were declining. And if we see more declines, I'll readjust this just to keep an eye on things. And then we have the Connors RSI, which I use like a regular RSI or momentum oscillators. We look for extreme positive or negative readings. We're not getting one now. And then when we're declining, I use a thing called anchored moving averages. And these are different than regular moving averages, where regular moving averages take the last historical data, add it up, and then divide by the number of periods that you're looking at, where anchored moving averages try to project things forward. And I have a lot of these attached to previous lows that may end up acting as some kind of support if we pull back. We did fall down below this short-term anchored moving average here, but we were able to get back above it, and now we're right back about at it. So haven't been really useful in doing analysis this way. And so I just kind of watch this chart and then pretty much show it in this video right now. There may come a time if we really start to decline when we're really watching some of these other levels and they'll come into play. The positive thing to take away from this chart is for the most part, all of these lines are continuing to go up. And so that's positive also. And then we want to keep an eye on the S&P 100, which is outperforming the S&P 500 on a ratio basis, but we're not seeing much of a divergence here between the price of the S&P and the S&P 100. We did get some new X's drawn in earlier in the week this past week, but then we had some O's drawn in before that, but no real recent X's or O's in here. This is a point and figure chart, and this doesn't take time into account, only price. So this has pre-configured amounts. So when the S&P goes up or down by a certain amount, if it's up, it'll be an X. If it goes down, it'll be an O. And it can take an hour for that to happen or a year for that to happen. Time doesn't really play into the whole thing. But when you look at all of this, we can see a lot of X's and everything is going up and to the right. So we tend to be more positive. This also generates signals, but we're not getting one right now. Then a long-term rainbow going from 50 periods up to 250 periods. We came down in top end. This is the 50 period moving average on top, but we held at the 75-day moving average, and then we were able to bounce up off of that. We didn't spend much time in the rainbow itself, so the lines are still continuing to go up, meaning that the long-term trend is still positive and intact. A long-term oscillator called a special K. We finally went positive on the weekly chart. It took a long time for that. We're also still positive here on the daily chart. And even though we're rolling over a little bit here, we're still well above this red line. This is longer term positive. And since we get so few signals with this chart, I only show it in this video. Then we want to keep an eye on the interplay between the US and Europe. We have the S&P weekly chart on top and the German DAX, which is the biggest stock market in the EU, in the middle area, and see that there's a pretty strong correlation between them, and that's pretty much normal. When they get out of line with each other, that's when we say, okay, what's going on here? How come they're going in opposite directions? Or how come the relationship isn't as strong as it used to be? Right now, it's fairly strong. So it's looking rather normal right now. Then this sometimes is short, sometimes intermediate, sometimes long term as far as a chart. This is the boom indicator, and this measures how far away are we from the 20, 50, or 200-day moving averages. We're not far away from any of them. We were not too long ago. We were actually getting kind of far away to the downside when we really declined. But we're in between the blue line and the red line here. So we're more neutral as far as this indicator. We're also slightly positive since we're above zero, but not too far away from the 50 period moving average. Also hanging in there fairly well with our distance above the 200-day moving average. So when we get too far away, we use this like an oscillator, looking either overbought or oversold. Then support and resistance, we set the all-time high with the S&P, and if we really start screaming down, here are some Fibonacci retracement levels. If we do go up and set another new all-time high, I'll readjust this. Some broad market measures, I don't focus on this all that much. Where I look at the VIX, well, there's a thing called the Vixen, which measures the volatility of the NASDAQ 100, and it's been going all over the place just like the S&P has. Then we look at the S&P on top, and then we do kind of an interesting ratio here. The Qs, which are growth and the mega cap stocks, versus the Dow, which is supposed to be more value, even though Nvidia is now part of the Dow. And we look at the correlation between the ratio in the middle and the S&P on top, and it's fairly strong. They're having a tendency to go in the same basic direction. And when this is going up, that means the Qs, the NASDAQ 100, are outperforming the Dow, and that tends to be more positive for the market. And it's also more positive for the S&P. Where if the Dow's outperforming and this ratio is going down, that could mean that folks are getting out of the riskier stocks and getting into more conservative stocks because the market's turning more defensive. We want to keep an eye on the Dow to the transports here. The black line is the Dow, the transports are the red line. And the transports were looking a lot better, but they've since really fallen off here compared to the Dow. And we want to keep an eye on the financial sector. And then one of those areas in the financial sector is the bank ETF. And we were getting concerned, setting an all-time high here with the bank ETF and then just drifting down, fell below its 50-day moving average when we had the big down day. Since that time, it seems to be stabilizing, but it's still under its 50-day moving average, although it's also in a longer-term uptrend with the blue line, 50 periods above the red line, which is 200 periods. Then we look at another ratio between the regional banks, the smaller banks, and the financial sector, pretty much going sideways, but still leaning towards an uptrend here. We want to keep an eye on this because there have been, over the last year, year and a half, regional bank, Silicon Valley Bank, New York Community Bank that have come out and reported problems. And if interest rates keep going back up, that could put more pressure on some of these smaller banks. And is that going to be a problem? Is that going to put some pressure on the whole financial sector and then a smaller part of the financial sector by the regional banking area? So we just want to keep an eye on this and see how it's doing. We also look at the staples to tech ratio. When this is going down, that means staples are underperforming, and that's pretty much what's happening here. But we've been fairly choppy. So I use this off and on. And when this is going down, that means the tech sector is outperforming, which is what we want to have happen when the market's more positive. And then this is kind of come and gone from the daily video as well. We look at a broad market measure of the 5 period moving average of the highs and lows. We had been positive for most of 2024. Now we're starting to drop negative, although we are improving. As long as we're below zero, that's more negative. If we can get back above zero, that means the internal structure of the broader market is turning back more positive. Then I look at some range of change charts just, and this is 200, it should be 250 periods, but this just goes back from Friday's close and then 200 periods ago. And we're trailing off a little bit here, but we're still looking quite positive. This is the chart that I focus on a little bit longer term. This is 250 periods where we were coming up above this blue line, and now we're starting to come back down below it as we've been under a little bit of pressure lately, but it's still positive. But if this could turn and go back up, that would be even better for the market. If it really continues to fall, that will be more negative longer term. We keep an eye on the relationship between stocks and bonds. First, we're here in this chart, we look at bonds to bonds, actually T-bills, which is 1 to 3 month, which you could pretty much call cash, and compare that to 3 to 7 year bonds. And the market's getting a little bit concerned about inflation. And the Fed has come out and said we're not going to cut rates for a while, and interest rates have been going back up, even though the Fed's been lowering rates. This ratio is starting to go back up, and it has been going up for a while after it looked like it was declining. This is a little bit of a concern, and that's why we're really watching interest rates pretty closely in the short term here. If this ratio keeps going up, that could put some pressure on stocks. Then we look at TIPS, which are Treasury inflation protected securities and 3 to 7 year bonds. This ratio is going down. So according to this, the inflation fears are more short term. Anyway, when this was really going up, that's when interest rates and inflation was going up. Now we're actually resuming going down here. And we look at a little further out bonds. Now this is going up. So short term, there's a little bit of concern with inflation. Intermediate term, not an awful lot of concern. But then longer term, because we're seeing longer term rates like the 10-year and the 30-year going up. And that's why we're seeing this ratio going up too. And that's we try to get the context as to why is this going up or why is this going down. And this is concerning the market with the 10-year yield that I look at the most going up, and we want this ratio to go down. That would be more positive for stocks. And the fact that it's going up is a bit of a concern. And we look at the long-term bond based on price and then compare it with the S&P 500. The S&P 500 is in red. Blue is the long-term ETF. And we see that the longer-term correlation is pretty much flat, not a strong correlation. And in the short term, 10 periods, we're seeing that relationship actually decreasing here as bonds have been going down more based on price than weakness that we've seen in the S&P. And we look at that same thing here with the QQQs to the long-term bond ETF, where we've been going down with price, holding up a little bit better here with the QQQs. So the correlation is not really strong. It's more neutral right now. And then just to get the interplay internationally between interest rates and currencies, the dollar, we look at the US 10-year yield and subtract the German 10-year yield. And since US rates are higher, we get a positive result. And then that result, interestingly enough, we can compare to the US dollar index. And you see there's a fairly strong correlation between the two. It's when they start to get out of line. That's when we get a little bit concerned. This is more of a normal type of relationship. We want to keep an eye on the 2 year yield, which is shorter term because this has been going back up now. It actually benefits the S&P if this is going down, but it's not really having that big of an impact right now. It's longer term rates that seem to be pressuring stocks at this point. Then we want to keep an eye on what's going on in Europe, and we compare European stocks to American bonds. Not doing all that great right now. The Eurozone ETF has actually been underperforming, and we're seeing a lot of spaghetti movement here with this rainbow. It would be more positive if the Eurozone would actually start to outperform bonds and begin to go back up. If this really turns down and shows more weakness, that might be a concern. Keeping an eye on the yield curves because for a long time, a couple years at least, the 10 to the 2 year yield curve was inverted. It's finally gone back to being uninverted or going back to regular, and it's still uninverted. And we were also watching the 10 to the 3 month where it was inverted for a long time. It's now back to being normal. And when you look at both of these, the 10 to the 2 year, the 10 to the 3 month, this is when we start the countdown to say, okay, are we going to go into a recession? And usually that's 5, 6, 7, 8, 10 months out into the future. And so we'll have to see. There are people that are concerned that we're going to go into a recession. There are other people that are not. We don't really listen to any of that. We look at the charts because the charts will tell us how the market is reacting. And the bond market going up, fearing inflation, that's kind of an initial warning. And now, if we start coming down with interest rates, that will be more positive. But if rates keep going up, then that could end up leading us into a recession. And then I have a number of things called possible positive scenarios. I use a number of those charts in the daily video. These are the charts that I don't use that much. I have a different study that looks at the percent of stocks in the S&P above their 200-day moving average. This is a different approach where we use this like an oscillator. When we get a really high or low reading, we're not getting one of those. We are still positive since we're above 50. We had been declining and now we're starting to bounce back up. So there's an improvement with this chart, but we're not really getting all that much insight. Then we look at the S&P with those stocks above their 50-period moving average. Also, I have a different study that I look at to analyze the same thing, just in a different context. We use this like an oscillator, and we had been really coming down. We actually dropped below 50, and that was turning this negative. We're still negative here, but we are improving. And then we look at the mid caps, really showing some weakness here, but trying to bounce back. And then the small caps also trying to bounce back with the latest reading here. So thank you. I really hope you found this helpful. Please feel free to check out the other videos that I post. Have a great weekend, and I will talk to you in the next video.